Western Digital just guided next quarter's revenue up 42 to 49% year over year, which basically confirms the entire AI storage bull case for this stock. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Western Digital gets graded and traded. So on the headline, revenue came in about 1.5% ahead of estimates at $3.75 billion. And year over year, that's up 44%. This is a hard drive company growing 44%. That's the AI storage story showing up in the numbers. And on EPS, the reported number beat by about 9%. But here's the catch. The GAAP headline was $8.21 a share, and about $2 billion of that was a non-cash paper gain on their leftover Sandisk stake. Strip that out, the clean non-GAAP EPS was $3.56. Still more than double last year, just nowhere near that $8 headline. So on the beat itself. And we're grading against the clean numbers here, not the Sandisk inflated headline. This earns a B. A clean plus 9% EPS beat paired with the revenue beat is solid, but not the blowout the reported number made it look like. And on consistency, this earns a B. They've been putting up beats through this AI storage cycle, but the track record isn't quite long enough or clean enough to push it higher. Let's talk about the positives from the report. Revenue hit $3.75 billion, up 44% year over year. This is hyperscaler and cloud storage demand, pulling every lever the company has. AI is driving real storage buys, and Western Digital is capturing it. Non-GAAP gross margin jumped to 54.4%, up 1,310 basis points from 41% a year ago. That is a massive step change in unit economics. Pricing power plus mix. This is peak cycle economics showing up. Full year free cash flow came in at $3.5 billion, up 145% from last year. That's the number that funds the buyback, pays down debt, and pays the dividend. This is a genuine cash generation story now. And management guided next quarter to $4.1 billion in revenue. That's up 42 to 49% year over year, with gross margin stepping up further to 55 or 56%. That says the cycle hasn't peaked yet. On top of that, they cleaned up the balance sheet. Debt is way down, and shareholders' equity grew from $5.3 billion to almost $9 billion. Materially cleaner capital structure heading into next year. So on profitability, this earns an A. Margin expansion of 1,300 basis points on gross and 1,600 on operating, plus 145% free cash flow growth. That is elite operational execution. Now let's talk about the negatives from the report. The $8.21 GAAP EPS number is misleading. $2 billion of it was a non-cash mark-to-market gain on their leftover Sandisk stake. The clean operational number is $3.56. Future quarters will keep seeing those swings that have nothing to do with the actual business. Receivables grew $540 million year over year, and inventories built up another $220 million. That's the one thing in this print I'd watch. A big receivables build during an upcycle can be totally benign, or it can be an early warning of channel fill before things soften. Cash on the balance sheet actually dropped from $2.1 billion to $1.58 billion, even though they generated nearly $4 billion in operating cash flow. That's because they spent $2.5 billion on buybacks and another $1.2 billion settling convertible notes. Aggressive capital return, but it leaves less cushion if the cycle turns. There was also about $146 million in realignment charges and over $900 million in debt and equity transaction costs running through the year. Meaningful, non-recurring noise that clutters up the GAAP picture. And on top of that, The tax rate guided for next quarter steps up to 17%, which is a modest headwind at the EPS line that partially offsets the guided margin expansion. So on guidance, this earns an A. The next quarter guide of 42 to 49% year-over-year revenue growth plus further margin expansion is a genuine conviction signal from management. That's a strong raise heading into the new fiscal year. And on red flags, I'm at a C. The working capital build is the one thing I can't dismiss. Receivables up $540 million during an upcycle needs a follow-up next quarter to know whether it's healthy shipping or channel fill. Putting it all together, the headline, $8.21 EPS, looks eye-popping until you back out the Sandisk paper gain. But the clean, non-GAAP number of $3.56 more than doubled year over year, and that's the real story here. This is a hard drive business running at peak cycle economics, with AI-driven cloud storage demand pulling every lever. Margins expanded 1,300 basis points, free cash flow jumped 145%, and management guided next quarter even higher. My one concern is the working capital build. Receivables and inventories both grew meaningfully, and that's the swing factor for next quarter. So I'm giving this print a B+. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. I'm not chasing this thing right after the print. I want to let implied volatility come back down over the next 5 to 10 trading days before I make any move. Instead of buying shares outright, I'd rather sell a cash secured put and get paid by that inflated premium while I wait. The IV crush window is where the wheel actually earns its keep for me. I'd look at strikes about 10 to 15% below wherever the stock settles after earnings. That's the zone where a guidance miss is already priced in, so I'm comfortable getting assigned there. So my play here is to wait for IV to crush and then sell puts. My floor strike has to survive a world where next quarter comes in at the low end, around $4 billion in revenue and gross margin closer to 55%. That's the price where I'd happily take assignment on the wheel. If I go closer to the money for more premium, I have to be honest that I'm truly comfortable owning shares at that strike. Otherwise, I'm just picking up pennies in front of something I don't actually want. The one thing that keeps me cautious is the working capital build. Receivables jumped about $540 million, and inventory climbed around $220 million year over year, and that's what could flip a good story into a bad one. So I'm anchoring my strikes to the low-end guidance, not the hype. I'm holding my shares here. Gross margin guided from 54.4% up to 55 or 56% next quarter, and full-year free cash flow of $3.51 billion tells me the thesis is intact. Nothing in this release makes me want to back up the truck at these levels, especially without seeing where the stock actually trades after the report settles down. The only reason I'd trim is if the stock has meaningfully outrun the target I set for it. Taking a little off the top after a big run is just good discipline, not a change in view. So my stance is hold and maybe trim if it overshoots. The guidance for next quarter jumped to $4 in non-GAAP EPS, up from the $3.56 just posted. That kind of jump means my near-the-money calls are suddenly at real risk of getting assigned. With revenue growth guided at 42 to 49% year over year, I don't want my shares called away at strikes set before all this good news landed. So I'd rather roll my calls up and out to strikes that reflect the new margin trajectory. I collect some credit, buy myself more time, and reset to a price that actually respects where the business is heading. My move is roll up and out, don't let them go cheap. I'm holding my long-dated calls. The full-year print didn't just confirm the artificial intelligence storage story, it accelerated it. Non-GAAP operating margin went from 24.4% to 37.3% for the year. Nothing in this release breaks my 12 to 24-month thesis. If anything, the numbers underneath got stronger, which is exactly what I want to see in my long-dated position. The only reason I'd roll strikes up is if the stock has moved well past my original target and I want to lock in some gains while pushing my expiration further out. So I'm holding my leaps. The thesis just got better. This report validates the original thesis on basically every operational number I care about. Revenue, margins, free cash flow, and forward guidance all point up and to the right, so averaging down is defensible here. But I'm not ignoring the working capital build. Inventory grew about $220 million, and receivables grew around $540 million year over year, and that's the one thing that could complicate the story next quarter. So I'd size any adds in pieces rather than dumping everything into one pullback. That way, if the working capital signal turns into a real problem, I still have room to work. My approach is add carefully and watch the working capital. Bottom line, this print earns a B+ from me. The AI storage thesis got validated with hard numbers. Margins, cash flow, and forward guidance all confirm the cycle isn't done yet. The working capital build is the one thing to watch, but the operational story here is real. Thanks for watching, and I'll see you on the next one.